Welcome to the Strategic Management Accounting course, where we teach the value-adding steps and processes necessary to execute strategy. Whether you are just starting up or looking to grow your business, then this course is for you. With your host, Dr. Neale O'Connor.
Hi, welcome back. It's Neale here, and we want to go through an additional example on customer profitability analysis. We haven't had a chance to go through this in the lecture, so let's go through it now, shall we? So you can get some more confidence about what it means to actually attribute the use of resources by different customers in terms of allocating different costs and different revenues. So we find out different customer profitability, and then is there some meaning in all this allocation process to the types of decisions we might need to make. So let's get into the good stuff, shall we? Now remember, let's get our laser pointer here. I love my little laser pointer here. All right, now remember, in the previous weeks, we were looking at value engineering, and remember, this was step 1 and step 5 of target costing, where once we decided we're going to hit a certain market, certain price point, functional analysis, then it was up to design analysis and process value analysis to get into that and actually work down those costs to make it sustainable and to grow margins over time. And this was all about cost down, cost down, cost down. Well, now we're over in week 3. We're actually looking at activity-based costing, and we're applying costs to different products, to different suppliers, to different customers. What is the whole purpose of this? The whole purpose of doing this is so we can make better decisions, so we can make more accurate decisions, so we can make a decision about which product we should make or buy. Which product should we continue to sell at a certain price point? Can we cut the price by 10% and still make a profit? Same with the customers. What we're going to learn in this example is if we use activity-based costing concepts to apply revenues and costs to different customers, is there some way that we can have more accurate information that enables us to make better decisions down here? Better decisions like which customers do we want to sell more to? Which customers do we want to kick out? Yes, not 100% of your customers are always your best customers. Maybe it's only 60%. Or even less. Maybe it's your 20% of customers that bring in 80% of your profits, but not 100%. So this is what we're going to find out in this example. So let's get into the good stuff, shall we? So remember, we're looking at customer revenue analysis, then we're going to look at customer cost analysis. We're going to combine them together to get our customer profitability analysis. And there's our little customer there. Yes, we know he's eating and eating and eating. Why does he eat like that all the time? Because he's eating your resources. As you're selling to the customer, you are incurring resources. And for most businesses, not all customers incur exactly the same amount of resources. And until you know the differences between the customers, you will be not in a position to actually start to manage your customers in terms of the ones that are profitable and the ones that are not profitable. Let's have a look at this example. All right, so we're going to look at customer revenue analysis first. What are we doing here? We're considering the activities that affect the net amount received from the customers. Now, customer revenue analysis traces the prices and discounts, including the sales and cash discounts to customers, and identifies the financing costs associated with customer revenues. Remember, some customers, because of their bargaining power, may cause you to give a higher discount, may cause you to give up to 3 months in terms. Yes, we know suppliers have to do that for Apple. Why? Because Apple is the big gorilla on the block. But for a small buyer, the suppliers will say, give me the money, 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 money. I want the money straight away. Give me the cash straight away. So you know that different customers are going to cost you differently because some have more bargaining power than others. And this is what we're going to capture in this revenue analysis. Let's have a look at a real example taken from a textbook. And this is Winsome Office Supply. They make office supplies and they sell to 3 customers: Jerry Company, Home Service, Advanced Tech. Here are the total sales: 500,000, 480, 540. What about the sales discounts? Notice Jerry Company, you had to give a 5% discount to Jerry Company, Advanced Tech, to convince them to buy from you. But you didn't have to do that for Home Service. Maybe Home Service did not have as much bargaining power. Yeah, that's a good thing, right? You know that. What about payment? You got 2 net 10, net 30. What does that mean? If Jerry Company paid within 10 days, then you're going to give a 2% discount. Okay, net 30 means there's no discount for early payment. And here we have again 2 net 10, net 30. Yes. So delivery, FOB destination, FOB shipping point. So Advanced Tech, you only had to pay FOB at the shipping point. But with HomeServe and Jerry Company, you had to send it directly to their destination. Maybe that cost you more. Maybe it cost you more than just sending it to the shipping point of Advanced Tech, where Advanced Tech took over from that site after shipping and then sent it through their own destination, you see. So there are these different customers have different demands in terms of how you are selling to them, what you had to promise to get their sale. What about sales returns and allowances? 1% for Jerry Company, 0.5% for Home Service, 6% for Advanced Tech. That means Advanced Tech returns 6% of their stock. Yes, it does happen. So we want to have a look at their revenue. How do these different terms that you offered at the sales time, how did that transfer into the revenue? Well, notice sales discounts at 25,000. Advanced Tech, you had to give up to 27,000 in discounts. What about sales returns and allowances? Advanced Tech, wow, $30,000 returns. There's a huge cost here. Jerry Company, a little bit less. Sales returns allowances. Home Service, very much less. Okay, now let's get down to the cash discounts. Now remember, Jerry Company was offered 210 net 30. That means if Jerry Company paid within 10 days, then you offered Jerry Company to give them 2% discount. And there you have that 9405. So there's your 9405 because Jerry Company paid within 10 days. Of course, that is diminished by the 3072. Remember, cash discount is taken off. This is a less discount because that's less cash that you're receiving from Jerry Company. But you have the benefit of actually being able to put that money to work for 20 days at 1%. So you're able to get part of that money back. So that's finance charge is a net positive. So the net difference for Jerry Company is a minus 6,333. You can see that off 470 to give you 463917. What about Advanced Tech? Advanced Tech was actually late by over 1 month. So therefore it's cost you 2 months in finance charging for Advanced Tech. 2 months finance charge. So instead of getting 482 in cash, you're only getting 472. With Home Service, you're getting 477 in cash net. So let's summarize this. Jerry Company has actually taken advantage of this discount you're offering. So you give a cash discount immediately. You can take that money because you received it 20 days earlier and get some benefit during those 20 days. So that benefit you've given a Jerry Company, you're actually earning it back because you've got cash 20 days earlier. Home Service, you did nothing. Advanced Tech was late paying, so that actually cost you. You had less cash in the bank. for an additional 30 days. They were 30 days late in paying. So the difference here is that for every dollar you sell to Jerry Company, out of 500,000, you're getting 463 in your bank account. For home service, 480,000, you're getting 477 in your bank account. Advanced tech, 540,000, you're getting 472 in your bank account. Interesting. Out of these, home service is way by far much more efficient. Now, that's the revenue analysis side. What we want to do now is go across to the cost side. Are these customers the same in terms of the cost they incur for you to sell to them? Basically, for you to deliver to them. Okay, here are the selling costs. Here, now we want to look at customer cost analysis, and we're interested in all of these costs that the customers may incur differently because they order different sizes, because they order different times, because they require more of the salespeople's support. For all of these different reasons, different resources are used, and we call them a cost analysis. And we want to allocate these costs to the different customers. Let's have a look at how we can do that, shall we? In some ways, we can actually batch these different costs into unit level, which is basically how many units each customer orders. Batch level, that is the order size, because some customers may order once or twice a month, but very large orders. Other customers may order 10 or 15 times a month, but very small. You can tell that the later type of customer is going to cost you more, not less. What about customer sustaining costs? Visits to the customers to make sure they're okay. Yes. Distribution channel costs, commercial versus retail. And sales sustaining costs, maintaining firm sales capability. A little bit more difficult to, allocate, but you put them in, okay, and allocate them anyway, depending on your purpose of your allocation. More about that later. So let's have a look at what we got. Here are the different cost drivers and the rates. We have all the different activities, and we've determined that on past analysis that it costs us $30 per order. Processing costs us $20 an order, plus $1 per item. Delivery, $100 per trip and $1 per mile, because some trips are longer than others. Expedited order taking, $800 per order. Expedited order taken, that is when the customer rings up and says they want it tomorrow, as soon as possible. Maybe you have to air freight it to them rather than ship. So therefore, $800 per order. It's extra for you to organize something special for that customer. Customer visit, $200 per visit. First statement, $5. Subsequent reminder, $25 per invoice. Sales returns, $100 per occurrence. Restocking, $5 per item returned. Salaries and fringe benefits, $100,000 per month. Office expenses, $50,000 per month. Again, let's have a look at how these cost drivers and rates line up in terms of the unit level, batch level, okay, customer sustaining or sales sustaining level categories, which really helps us to understand when and where the resources are being consumed. So ordering is a customer batch level, and so it's very easy that we've got $30 per order, $20 order at batch level, but the items are a unit level. Delivery is a batch level because you deliver in batches. Expedited order taken is going to be batch level. Then we got customer sustaining levels, which is more about looking after the customer. How often do you have to visit them to convince them to buy from you, to order from you? Are you okay? Is there anything we can do for you? How was the last shipment? Any feedback? All these questions, extra visits. Some customers require an e-statement. Other customers may require a printed statement. right? Some customers require reminders, others don't. These are sustaining costs. Sales returns. Some will return more, others. It's a batch level. And then restocking, of course, it's going to go up if there's a return of 10,000 units versus a return of 1,000 units. You can see that these are all ways in which we can distinguish different costs that are being incurred by your different customers, depending on the drivers, that is the resources the customers are consuming of yours. So let's have a look at how they add up with our three customers, shall we? So we've got Jerry Company, Home Service and Advanced Tech, and here are the resources that they have consumed. Number of orders. Jerry Company, what do? Jerry Company does 2 orders a month, and at each time there's average number of items per order is 400. Advanced Tech, 80 orders per month, but the average number of items per order is what? 8. Right off the bat, you can tell that Advanced Tech is going to be much higher maintenance than Jerry Company. Just 2 orders, here 80. Wow. Your order processing is going to be very, very busy with this customer, not so busy with this customer. You can see the difference already. Delivery miles, Advanced Tech, double Jerry Company. Expedited orders, Advanced Tech, 5 times a month. They ring up, give me my order immediately. I want it tomorrow. Okay. And then you have to do special deliveries. You have to reprioritize different orders. You have to do things that cost you money. That's extra resources Advanced Tech is consuming of you. Number of visits for salespeople. Wow, this Advanced Tech is very high maintenance customer. Wow, do you really want to have that customer? I don't know. What about sales returns? Number of requests. Well, sales returns, Jerry Company, not so many. Advanced Tech, wow, I can't believe it. So many returns. Average units per return, 3, 4, and 2. Not much difference here. So we can ask you 2 questions here. Which customer has higher batch level order activity costs? Immediately you can know the answer to that, don't you? Which one is it? Jerry Company, Home Service, or Advanced Tech? Yes, you got it. It is Advanced Tech. You can see the order costs are very, very high here. And delivery. And what about which customer has higher customer sustaining level visits, activity costs? Is it Jerry Company, Home Service, or Advanced Tech? Yes, you got it. It's Advanced Tech. So you can see I haven't done any cost allocation here. What we've got here is basically some quantification of the resources, the different resources that these 3 customers are consuming of your company. That's Winsome Office Supply. These are the different resources. Now let's transfer that into some cost analysis, shall we? Let's have a look. So what we're doing is we've got our resources consumed by Jerry Company, Home Service, and Advanced Tech multiplied by our cost rate, $2, $1 per order processing here per unit. And then we've got restocking fees, how many times they've been restocked, and the restocking fee is $5 each time. We have order taking fee of $30, and you notice Advanced Tech has an order taking fee of $30 too, but Advanced Tech used the 80 orders, Jerry Company only used 2. What about trips? You only do 2 trips at Jerry Company, 20 trips to Home Service. What about the expedited orders? Well, you didn't have to do delivery trips here, you just had to expedite to Advanced Tech. Notice 5 of them, there's $4,000 costs incurred there. You can see customer sustaining costs. We have sales visits 1, 2, and 5. Immediately Advanced Tech is costing you more here, $1,000. In total, Jerry Company is costing you $1,555. Home Service is costing you $4,585. Advanced Tech is costing $10,795. I can't believe it. Wow, they're so expensive. This customer is so high maintenance. Do you really think we could keep this customer on our books? Should we? That's another question. Again, this is what this analysis is all about, to force you to think as a manager. Do you want to keep all of these customers on your books when one is really, really expensive? One is very, very cheap. Let's come back to that in a minute. Remember, let's have a look. Why is advanced tech so expensive? Because they order so often for so little, because they expedite everything, because they require so many sales visits, they require so much hand-holding by the salesman. They want that relationship. They want that tender, loving care. Jerry Company couldn't care less. Once a month is good enough. And we're going to do 2 big orders, and we're very maintenance free. Advanced tech, they're the opposite. You can see the difference here. And these costs are telling management to be careful when you start to treat this customer the same as this customer here. Now let's see what it looks like when we put both the revenue, sales revenue costs allocation alongside the customer support costs allocation, shall we? Here we have the sales revenue costs allocation. Home service is the best out of these. Jerry Company, not too bad. Advanced tech is pretty good. Home service was the best. But let's have a look at the customer costs. And here we have all of the different costs as per allocation, going down $15.55 for Jerry Company. Very low maintenance compared to $10,795 for advanced tech. Very high maintenance. I don't know if I want this customer. So let's have a look at the end. The net customer profit here is you sell 500,000. How much is in the bank? 462. You sell 540 to advanced tech, thinking, wow, we made more money from this customer, but only 461 comes to your bank account as a result of working with this customer. If we do the allocation correctly, home service 480, the less out of all three, but in terms of bank, we get more bang for the buck for selling to home service than we do from Jerry Company and advanced tech. Notice that advanced tech is our least profitable customer versus Jerry Company and home service. So you can start to think what this could mean if you just showed this to management. Maybe management want to cut down the number of sales visits. Maybe they want to cut down the number of salespeople, and they're thinking maybe this can tell them, well, maybe if we don't have advanced tech as our customer, maybe we don't need as many salespeople, and we can still have, if we can get more of Jerry Company or home service with 20% less salespeople, then we don't need to have advanced tech, and we can still bring in the same amount of money and reduce our sales costs. See that? That's one decision. Number two, we can make a decision, advanced tech, you're costing us more. Maybe we want to start charging you more for these services. Maybe we want to start charging $1,000 per expedited order to force advanced tech to change their behavior, you see, so they become more like Jerry Company or home service. You see that? It's not until we allocate cost to these different customers at the sales cost level or at the delivery cost level, we can begin to think about these different decisions about how we can better allocate our sales resources, or how we could better work with the customers so they become more like our most profitable customer. How can we work with advanced tech to make it more like Jerry Company? Maybe start charging them more for expedited orders so they stop doing that, you see, and then they change to giving you orders more in advance and suddenly they'll become more profitable for you. Can you see that? Another decision you could make is, let's drop advanced tech. Let's drop them. One reason is maybe you want to cut down the salespeople, as I said earlier. So there's two clear decisions that you could make on the basis of this analysis alone. Again, we need to think about other qualitative aspects. For example, if we drop advanced tech, maybe we will lose so much market share, competitors will start working with them. Maybe we may not be able to serve Jerry Company or Home Service as well. Maybe advanced tech is just a backup, like a buffer for extra capacity that we would otherwise be free if we didn't have advanced tech. So we've got the capacity there. We might as well just serve advanced tech anyway. So it doesn't cost us more to serve them. So we might as well keep them as a customer. All right, so we need to keep in mind these other qualitative aspects in terms of the market. Keep being in the market versus not being in the market. If you cut an unprofitable customer, thinking about your capacity that you have. If you drop them, you're just going to have excess capacity anyway. It's not like that you're tight on capacity. You may have to lay off people, and you may not be able to expand it as much in the future. So there are a lot of different things you need to think about on the qualitative aspect. But for now, the big thing to take away is how we can use activity-based costing principles to allocate costs to different cost drivers that proxy for the resources consumed by different customers, that feedback to management to think about how can we make better decisions in terms of how we serve the customers, how we sell to the customers, and how we retain our customers over the long term. So there you have it. I hope to see you in the lecture. We're looking at this area here where we apply an activity-based costing principles to make more accurate decisions relating to the products we make, the customers we serve, or the suppliers that we source from. Okay, catch you in the next example, and thank you for paying attention. Bye for now.